check, 1, 2.
Go! Curious about real estate? Yes! Then you've come to the right place. Get the knowledge you need. Get over the fear and get started. This is the Michael Quarles Real Estate Show with your host, Michael Quarles.
Hello, everybody. Michael Quarles with podcast is 141. We have 5 questions sent in by real estate investors, and I'm going to try my best. And remember, if you have a question, send it to support@bsffacademy.com. Here we go. Question number 1. On the podcasts, you demonstrate negotiating price. When do you negotiate terms, seller financing, sub-2 financing? That happens after we get it under contract on most occasions. We then go back to the seller when there's an opportunity for us to, and the Ryans get involved and start renegotiating those things, or an angel gets involved and renegotiates for those items. So yeah, we always want to get a contract first. Cash contracts are always the easiest, unless the seller just flat out tells us, hey, we want to do seller financing or sub-2 financing. Most times sellers won't just come out and say that. So cash contract first, and then renegotiate afterwards. There's nothing wrong with it, in my opinion. Question number 2. Do you negotiate terms after the contract is signed at agreed upon price? Yes, we do. After the contract signed at a future date while we're in escrow, keep in mind that we're in escrow for 60 to 90 days. And during that period of time, it gives us an opportunity to become more involved and more liked by the seller, for lack of better words. And we can start looking at terms at that point when the seller lets us know they have a situation where terms benefit them. Terms are always going to benefit us, or most likely always going to benefit us. In some occasions, the seller is going to come out and say things that tell us terms are going to benefit us or benefit them, and we're going to start that conversation. We're always looking for terms. Question number 3, are terms written in the purchase contract? They are. So they're written in as an addendum to the purchase the original one, and then they're made part of it as that addendum number 1, addendum number 2 kinds of things. If you're a coaching student, the addendum form is in the resource center.
Thanks for listening to Buy, Sell, Fix, Flip. We'll be right back. Are you running out of leads? It's time you tried Yellow Letters at yellowletters.com. Get motivated seller leads through yellow letters, postcards, zip letters, typed professional letters, greeting cards, door hangers, and business cards. Yellow Letters is a full-service marketing company created with your success in mind. Get the personal attention you need to get your direct mail campaign started, and get in touch at yellowletters.com.
And we are back in 3, 2, 1.
Question number 4. I can see that there are a million variables for negotiating terms, but would it be possible to demo subject to and seller financing terms on the podcasts? It would be. I don't know if I want to take that long to do that. If you're a coaching student, go to the role playing that we do and we have recorded, and there's plenty of opportunities to hear that stuff there. And we do a lot of stuff in the coaching program where we go over this stuff pretty thoroughly. The reality is we say things as we start chatting with the seller. Even in the original inbound scripts that we use, we're bringing up some things. And one of the comments that we make or the questions that we ask is, after I take care of the mortgage and pay all the other costs, how much were you hoping to walk away with, what we call the walkaway money? Just that little comment, after I take care of the mortgage, opens up the conversation later for subject to, because we're taking care of the mortgage. We're not giving them the money to take care of the mortgage. We're taking care of the mortgage. And let's face it, buying subject to is the fastest and easiest way to get a home sold. And that also applies to seller financing as well. Sometimes on the seller financing, it's in the best interest of the seller to go ahead and offer seller financing. They can offer straight seller financing where we get a deed, or they can do an installment sale where we don't get a deed. Either one, I'd rather have the first instead of the latter, but either one of them are okay with me. especially if they're landlords. I mean, all they've been doing is seller financing it anyway. They just took a rent check instead of a mortgage payment. And so it's really easy to convert there. And when you start talking about tax consequences of selling something that has been that's a depreciable item, and that has a gain to it, you subtract your boot from all that kind of stuff, and you look at your tax basis. It could be in the seller's, not in the seller's big benefit to go ahead and just do a straight sell. They may want to do an installment sell or a seller carryback, and so that they're collecting the money and taxed on the money they collect. They're not being taxed on the entire sale until they collect the money. So there's all kinds of things that we can start talking to the seller about and fall forward. Question number 5. Would there be, or has there been, a situation where you would not want to negotiate subject to or seller financing? Yeah, I wouldn't want to do it on a property that's in foreclosure or in close to sell date. It doesn't get me excited to bail someone out that hasn't tried to help themselves in the 90 days or 100 days before the trustee sell. So that doesn't excite me. Doesn't it excite me when the seller wants too much money on seller financing from a point perspective? It doesn't excite me when the seller doesn't set the terms or doesn't agree to the terms that causes me to want to do seller financing. I might as well just pay cash for it. If there's too wide of a spread between my cash purchase cost to the property and my seller finance cost to the property, that it doesn't make any sense to go the seller financing. And you'll know those times when you start doing mathematically the formulas on them and determining what the exposure is going to cost you. Seller financing is typically always better than cash, but sometimes the seller could want 10% and all kinds of crazy stuff. So sometimes that doesn't make it beneficial. And sometimes the seller does it, they don't want to be paid off because they have that tax consequence. Although they'll do an exchangeable collateral, maybe I don't have any collateral to exchange the note to, and then I'll have to go uncollateralized on the note. And as long as the seller is comfortable with that, I'm fine with that. I'm going to pay it off anyway, but there's some issues there. The sub 2, again, is about the only time I wouldn't want to do that is if it had a high interest rate. It wouldn't make sense then, especially if it had a high interest rate and it was in a long period of days on market area. So, if it was 6 months days on market and, it had a 12% interest rate, that's going to make that mortgage payment pretty high. So if I can't mitigate that payment by getting the seller to make the payment over the next 6 months, I'm probably not going to take that house subject to. I may not take that house anyway if it's hard to sell. And so we look at all those things and try to make the best deal for both parties, us and them. It always has to be a win-win. It can't be completely one-sided or shame on us. So great questions. Very good questions. These are the kinds of questions I really like because it starts making us all think and how we can do things better. And I think that's always a good thing. And so keep them coming, and we'll talk some more. Talk to you tomorrow. Bye-bye.
Thanks for listening to the Michael Quarles Real Estate Show. Get more info and stay in touch at michaelquarles.com.